Welcome back, everybody. If you watch my channel, you know that I spend a lot of time analyzing stocks, comparing ETFs and their performance, and trying to understand the markets and financial news. But the reality is, for most people, that's a big waste of time. Now, I'm not saying that I want you to stop watching my videos, but there's a simple one ETF investment plan that would make things better for the majority of people. And it breaks down like this. Step 1, buy an ETF or index fund every paycheck that tracks the S&P 500 like Vanguard's VOO. Step 2, work on ways to increase your paycheck so you can invest even more. And step 3, keep on repeating step 2. And that's it. Now, obviously, there are infinite numbers of ways that we can make this more complicated. With things like what type of account types are people using, why the S&P 500 index at all, instead of these other ETFs that have either performed better or are more diversified or whatever. But I'm going to stop you right there because that type of talk is exactly why a lot of people are struggling to even start getting invested. Because once we start talking about investing, we tend to start talking about how to optimize your investments almost immediately. With things like, how do you find the best growth ETF? Or how do you find stocks with long-term growth potential? Or even, how do you leverage tax-advantaged accounts for maximum tax efficiency? And those are all great questions for the 20 to 30% of us that really love digging into the details on this stuff. But most people just aren't there because they're not sitting around wishing they could optimize their investments. They're wondering how to even get started. So in this video, we're going to talk through what the data says about investors and their needs, why the S&P 500 makes a great starting point for most people, and how the S&P 500 stacks up against other popular investments. So let's go ahead and start with, what does the data actually say? Now, the company Stash did their 2023 investor survey, and here are some of the interesting numbers that they found. 90% of Americans are interested in investing. That's great, but nearly half said they had a lack of knowledge or how to get started. And even worse, only 13% reported feeling comfortable making investment decisions. Plus, about 45% of those who actually had retirement accounts admitted to not fully understanding them. And then only 31% said that they had non-retirement investment accounts. And when you see those numbers, they roughly match up with the Gallup data that says about 61% of U.S. adults own stocks either directly or through their retirement accounts, which to me says that there's almost 40% of U.S. adults that don't. Now, obviously, you may have some that are invested maybe in real estate only or some other assets, but I'm guessing for the majority, it means that they're not investing at all. And we see that when we look at the average 401k balance by age. And especially as cost and inflation has risen, these numbers become more worrisome. And while obviously retirement is a huge worry and something that we all have to think about, it's not the only worry. And if we take a look at the breakdown of top concerns by generation, and this was taken from multiple data sources and stitched together, we see that for baby boomers, the top concerns are healthcare costs, financial security in retirement, and legacy and inheritance. Now for Gen X, it's balancing work and family life, retirement security, which is basically having enough for retirement, and then economic uncertainty, which is more around job security or current income. And then for millennials, student loan debt, affordable houses and living expenses, and then climate change and the future. And then lastly, for Gen Z, economic and political instability, mental health and well-being, and then finding meaningful work and purpose. And what you notice here is that outside of maybe 2 or 3 of these, they're all related to money and financial security. And this is why investing is such a critical thing for people to be doing, because it's something we can actively do to contribute to ourselves, to our families, to help build a stable foundation for the rest of our lives. And that's why I say being able to optimize your investments and learning how to do that is great. That's where I spend probably most of my time nowadays and what you see on this channel. But for the vast majority of people, it's just not the most important thing. What they need is a very easy to understand plan to help them get started. And simply building the habit of investing a part of each paycheck into the S&P 500 is an absolute great and easy way to do that. Now, of course, as with everything, I have to caveat this. I'm not a financial advisor. This is not some fully fledged investment plan that takes account all the possible risks and all that. It is just a bare bones way to get started with investing that literally changed my own life. So let's talk about it a little bit. What exactly is the S&P 500? Now, it stands for the Standard & Poor's 500 Index, which is roughly a list of the largest 500-ish companies or so in the United States. Now, usually when people talk about the market or the market performance or how did the market do today, they're talking about the S&P 500. And how I usually explain it to folks is that investing in the S&P 500 is like betting on the American economy to continue to do well. And over the past 100 years or so, that's been a very good bet, with the S&P 500 returning an average of over 10.5% per year over the last 100 years. And that's assuming that you're reinvesting your dividends, but still, that's pretty amazing performance for literally just buying, holding, and letting your dividends reinvest. And it's the index fund that Warren Buffett famously said most people should just be buying and holding, and they'll probably do better than 90% of the other people out there. And honestly, that was one of the reasons why I started with the S&P 500 when I finally got a job to where I made enough money to start investing. And I've told the story before, but I was laid off from my first real job after college, and I had no savings, no investments, and that's when I had to start taking money seriously. I was reading everything I could, just trying to learn, and eventually I finally got a good job where I could start investing. I simply put everything in my retirement account in an S&P 500 index, and I did that for years before I invested in anything else because that's all I knew. And I just kept contributing every year, kept working on increasing my income and doing well at work, and it worked out pretty well. And the reality for most people is that focusing on ways to increase your income and increasing the amount you invest over time is what's going to get them the best long-term returns, instead of spending that time trying to research investments and optimizing for the best one, because regardless of what anyone out there tells you, income does matter. And let me show you an example real quick that I think will explain it a little bit better. Trying to go from where you are now financially to being financially independent is just like a map. There are different paths you can take to get there. There are different modes of transportation you can take, which have different top speeds, and they all contribute to how far you can go and how fast you get there. Optimizing your investments is like choosing the most optimal path. Maybe it's the one with the shortest distance or the least amount of stoplights or the least amount of traffic, but your primary income source is like your mode of transportation. If you're still working that entry-level job and struggling to make ends meet, that's like choosing the walking speed on your map. Yes, you'll have a plan, you'll know where you want to go, but it's going to take forever to get there. And optimizing that plan for the shortest path helps, but it's ultimately still going to be slow. But let's say you get a slightly better job. Now it's like you're on a bike, significantly faster than walking, no matter which path you take. And then lastly, let's say you get that great high-paying job or business. Now you're driving in a car. So something that would have taken you hours walking now only takes minutes. And at that point, when you're driving in the car, yes, optimization can really help because you're already going at a good speed. But that's why I say if you're not happy with where your income's at, your time is probably best spent coming up with ways to increase your income than it is optimizing your investments. And that's why focusing on a broad market index like the S&P 500 and just contributing to it every paycheck is a great place to start, because then you can use your time to really focus on building your income until you get it to a point to where you're ready to really optimize what you're invested in. Okay, but you might be wondering, what about these other alternatives? Like, why invest in the S&P 500 when QQQ has outperformed it over time? Or maybe VGT or SMH, or why not invest in VTI, which is the total stock market and not just the S&P 500? Or why not invest in VT, which is the whole world index? Or why not SCHD for dividends? Now, ultimately, it doesn't have to be the S&P 500 index if you have a strong preference for something else. But the reason why I like it is because I feel like the S&P 500 is a nice combination of a few different things. It's mostly established large cap companies. It's market weighted, so the best companies rise to the top and improve the performance of the index over time. It's a blend of both growth companies and value companies, and so over time it does well because it can do okay in most types of markets. There are always exceptions, obviously. But other index funds can work great as well. It just depends if you have a strong preference for one over another. Now, in terms of the ones I mentioned, I'll go through each one and talk about how they're different. Now, QQQ has outperformed the S&P 500, but in general, it's considered to be riskier since it's focused on companies that are listed on the NASDAQ and more tech-focused. With VGT or SMH, they've performed great, but they're also sector-specific ETFs. VGT is information technology and heavily concentrated into three companies, which is Microsoft, Apple, and Nvidia. So it's obviously riskier than the S&P 500 overall. SMH is a semiconductor ETF. It only has a total of about 26 holdings, and about 27% of the ETF is in Nvidia. So again, it's had amazing performance, but it's considerably more risk than the S&P 500 by itself. Now, VTI is a total U.S. stock market, and it's very similar to the S&P 500 index, which again is Vanguard's VOO. They're basically 86% the same fund, but VTI does include small caps, so if that's something you're interested in, then maybe it fits better. VT is the world index, and people talk about it for maximum diversification. For me, it just hasn't performed as well as the US-based funds, and for all the problems that the US has right now, in my opinion, is still the best place to put my money, and so something like VT doesn't really interest me. But if it does for you, then it can definitely be an option. And then lastly, SEHD. Now, if your goal is to build a dividend income stream and you know that going in, even if you're just starting, then there's nothing wrong with investing in something like SEHD or another dividend ETF. Just make sure that if you're really wanting long-term growth and you're not planning to use the dividend income right off the bat, then it might be better to start with a more broad market index fund that has more growth prospects and optimize for dividends later. All right, so just to hammer this point home, the reason why this method works is that it focuses on the human challenges with investing, especially when you're just starting out. We don't have the confidence to know what to invest in. We don't usually have the time or want to spend the time to do a bunch of research, and we don't want to get caught up in the emotions and ups and downs in the market. And that's the beauty of this approach because, number one, it's easy to explain. An investment in the S&P 500 is a bet that the biggest 500 companies in America will continue to do well over time. And then two, it takes the emotion out. You can automate it to come out of your paycheck every 2 weeks and automate the dividend reinvestment. That way, you don't worry about what the market's doing on any given day. It just continues to build without you having to do anything. Which leads to the last benefit, number 3, it doesn't take up a bunch of time. Since you're not worried about researching, you can spend time with your family or building up your skills to earn even more income so you can invest even more money. And then rinse and repeat. So I know if you watch my channel normally, you're probably like, wow, this is great. But if this is true, then Matt, why are you researching all these stocks and then buying individual stocks and just in general underperforming the market? And I'll say, wow, that's a low blow, but okay. But all jokes aside, I've talked about this a little bit before. We still have a couple accounts that I don't really talk about on the channel that are just invested in the S&P 500 index. For example, my wife's retirement account has always only been invested in the S&P 500 index, and it still is. But for the majority of my stock portfolio that you guys see, we've chosen to invest in individual stocks in the hopes that we'll be able to beat the market over the long term. And obviously, only time will tell if we're actually able to do that. But I really enjoy doing it, and that's a big factor as well. For most people though, if doing that work and spending that extra time is of no interest to you, that's totally fine. And that's why I say having a simple plan of investing in the S&P 500 where you automate your contributions and keep building your income so that you can keep increasing your contributions every year is a super simple strategy to do really well. Especially if you were like I was, where you were starting with no investments or no savings at all and you just needed to build that foundation for yourself. It's such an easy way to do it, and it's exactly what we did, and honestly, it changed our life for the better. So what do you guys think about this super simple investment plan? Do you think it works for most people? Let me know down in the comments below. Now, if you guys want to hear more about investing in index funds versus individual stocks, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.